Okay, in this video we're going to look at some Chapter 12 practice problems. The first one I had in mind is this exercise 12-2 shown on the screen. So the setup said the Regal Cycle Company makes three types of bikes, the dirt bike, mountain bike, and racing bike. And data on sales and expenses for the last quarter are shown in the box here. We're also told after that that management's concerned about these continued losses shown by the racing bikes, at least on paper, and wants a recommendation as to whether or not the line should be discontinued. We're also told that the special equipment used to produce the racing bikes has no resale value and does not wear out. So that's this line item here. Essentially we're saying that's a sunk cost. If we get rid of the racing bikes, then we're not going to avoid that cost in any way, shape, or form. So the first requirement is to determine the financial advantage or disadvantage per quarter of discontinuing the racing bikes. So there's a couple different ways we can do this. The first way would be to lay out the combined scenario with and without the racing bikes line and just look at the bottom line difference. So I've jotted down the line items here to do that. We're saying this is with the racing bikes. So total sales as shown in the box, $300,000. Variable expenses of $120,000 for this contribution margin of $180,000. Then we have the fixed expense totals, again shown right there in the box. Manager's salaries, allocated fixed expenses at $60,000. Total of $148,000 for net income of $32,000. So let's talk about what happens if we get rid of the racing bikes. Sales then drops off by exactly the amount that the racing bikes generate in sales. So our total sales of $300,000 minus the $60,000 that we sell in racing bikes, for sales of $240,000. Similar idea for the variable expenses. We could add up the dirt bikes and mountain bikes, or take that combined total from the far left column minus what the racing bikes do. Contribution margin, similar idea, $180,000 total minus the $27,000 that the racing bikes generate. There's our CM of 153. Now advertising is entirely traceable, so we would avoid the expense of the racing bike advertising, so we'll back that out. Depreciation, again, that's essentially sunk, so there's going to be no change there. Manager salaries, presumably we will lay off the manager of the racing bike line, so we won't be paying their salary. And then allocated common fixed expenses, so there's going to be no change there in total to the allocated fixed expenses. So our total fixed expenses, the sum of those four items, are $132,000. And then if we subtract the total contribution margin minus the total fixed expenses, there's net income of $21,000. So they said, what's the overall advantage or disadvantage? Well, then it's the $32,000 in net income with the racing bikes minus the $21,000 without, and that's $11,000 disadvantage. So I don't care if you show that as a negative or a positive, as long as we're clear on what that means. If we drop the racing bike line, we're $11,000 worse off compared to when we keep it, despite the fact that it looks somewhat unprofitable on paper. And this is consistent with our study from Chapter 6, our segment reporting. We talked about some similar considerations for segment reporting. So the second way we could do that is to just think about what changes if we drop the racing bike line rather than doing these big combined scenarios. So what we'd be losing in contribution margin if we get rid of the racing bikes is that $27,000 in contribution margin that the racing bikes generate. What we'd be potentially saving, though, is the advertising expense that we would not be incurring of $6,000. Again, depreciation was a sunk cost, so we can't do anything there. Salary of the product line manager, we'd be saving that, so $10,000 there. And then again, allocated common fixed expenses, no change. So our net difference is the $27,000 in lost contribution margin minus $6,000 in advertising minus the $10,000 in the manager's salary, and there's our same change of $11,000. Again, if we wanted to be extra explicit, we could show the $27,000 in lost CM as a negative number, and then sum that up, and this is essentially $11,000 in the negative direction. I don't care what we show there, as long as we're clear again on the impact. We are worse off to drop the racing bikes line. So the second requirement just said, well, should the production and sale be discontinued? Our general answer then would be no. It is potentially profitable, even though it doesn't look it with these allocated common fixed expenses being dumped on it right now. And then the third part said, prepare a properly formatted segmented income statement that would be more useful to management in assessing the long-run profitability of the various product lines. So that's kind of a recap or rehash from chapter 6 for us. So remember, we said if we want to show that segmented income statement in a way that's a better indicator of potential segment profitability, really we should be shooting for segment margin. And just to be clear, we said segment margin was contribution margin minus traceable and avoidable fixed expenses. So if we were showing that, we might have sales, variable expenses, CM, and then we want to have traceable, avoidable fixed expenses. So here that would be advertising, the manager's salaries, and then nothing else. And that would get us to a segment margin measure. So for the racing bikes, let's plug in some numbers there. 60,000 in sales, 33,000 in variable expenses, 27,000 in CM. That advertising was 6,000, manager's salary was 10. So that segment margin, again, the CM of 27,000 minus those traceable, avoidable fixed expenses, and there's our segment margin of 11,000. And that fits with our early analysis. We're saying the racing bike line contributes 11,000 in segment margin toward the company's overall potential profitability. All right, next we're going to take a look at exercise 12-3, which is a make or buy decision. And with make or buy, we're really looking for just what's the cheapest alternative, essentially. So this said Troy Engines makes a variety of engines for use in heavy equipment. They've always produced all the necessary parts for their engines, including carburetors, but an outside supplier now is offered to sell one kind of carburetor to them for $35 per unit. So to evaluate that offer, they've gathered the following information relating to its own cost. So we see direct materials, direct labor, variable overhead, traceable fixed overhead with an asterisk that says 1/3 is supervisory salaries and 2/3 are depreciation of special equipment that has no resale value. And then the fixed overhead that's allocated shown there as well. The first requirement says, assuming the company has no alternative use for the facilities now being used to make the carburetors, what's the financial advantage or disadvantage of buying 15,000 carburetors from the outside supplier? So again, a few different ways we can do this. Let's just throw our make and buy scenarios side by side though and figure out which one's cheaper for the company as a whole. So we'll go line by line and think about the different cost items shown and whether they apply in both cases. The first thing I'll put up here is purchase price. So if we make these things internally, we're not going to buy it from the supplier. If we do buy it from the supplier though, we said, well, that's going to be $35 per unit. And we've got 15,000 units we'd have to purchase. So total purchase price of $525. If we're producing this thing, we've got direct materials, $14 per unit, times the 15,000 units, or the total is shown there in the box already, but 210,000. We wouldn't have any of that if we bought it from the outside supplier. Direct labor for that would be a total of 150,000. Again, 0 if we buy it from the supplier. Variable overhead, by definition, varies with volume. So we would have this 45,000 if we continue to make it, but again, we'd have nothing if we bought from the outside supplier. Now, fixed overhead traceable. Remember, we want to consider the fact that traceable doesn't always equate to avoidable. So we were told here 1/3 of this was supervisory salaries, 2/3 was depreciation of special equipment that didn't have resale value. So the depreciation of special equipment, essentially a sunk cost, that's unavoidable, whereas the 1/3 supervisory salaries are presumably avoidable. We can probably, unfortunately, eliminate those positions if we buy from the outside supplier, so that portion is avoidable. So again, you can focus on the difference, or if you're doing sort of a side-by-side comparison as we are here, we can just focus on the totals in each scenario. And what we're saying here is if we make this is the full 90,000. If we buy it though, the only portion that remains would be that depreciation of special equipment. So that's 2/3 of that $90,000, or $60,000 in total. Then we've got some fixed overhead that's allocated, and that we would presume would stay no matter what. Okay, if it's being dumped on this particular product line from the total allocation pool, so regardless of whether we make this thing in-house or buy from the outside supplier, we're still going to incur that full overhead cost. So we can get a grand total here for our make scenario. Again, our variable cost of production plus some of those fixed costs. And then if we buy, we've got the purchase price plus those fixed costs that are not avoidable if we forego making this thing in-house. So as we can see here, the total cost if we buy is $720,000. If we make it $630,000. So the difference, just to be explicit, $720,000 minus the $630,000, we're saying we're $90,000 worse off if we buy from the outside supplier. So all things equal, we should continue to make it in-house. And that's really what question 2 asks. Should the supplier's offer be accepted? Well, no, we're going to be worse off. The reason we're worse off, of course, is because we can't avoid a whole bunch of these fixed costs. It looks kind of cheaper at first glance to buy from the supplier, but we're stuck with some fixed costs that kind of change that decision point. Number 3 said, suppose if the carburetors were purchased, Troy could use the freed capacity to launch a new product. The segment margin of the new product would be $150,000 per year. Given that new assumption, what would be the financial advantage or disadvantage of buying from the outside supplier? So that's a great example right there of an opportunity cost. Right? We said opportunity cost was defined as the potential benefit we forego by choosing one alternative over another. So we can incorporate that in our analysis, especially since we have a good estimate of a dollar amount there. That line item said the segment margin of this new product we could make would be $150,000 per year. So technically, opportunity costs are costs of continuing to do business in-house in this case. So what we're saying is that adds a cost of $150,000 to the make side. Now similarly, we could subtract it as a benefit of buying from the external supplier, but again, opportunity cost, technically a cost of foregoing one alternative to choose another, so we'll add it on the make side. And part 4 says, given the new assumption, should the outside supplier's offer be accepted? So we'll combine these two answers in one. Again, if we think of the total cost at each scenario, now that changes our decision point. The make side becomes $780,000 in total. That buy side was still $720,000, so now it's cheaper by $60,000 to buy from the outside supplier. Again, because we could use this empty production space to make a new product that generated some segment margin and was profitable. All right, let's take a look at exercise 12-4, a special order decision. So the setup there said Imperial Jewelers makes and sells a gold bracelet for $189.95 normally. Their accounting system shows the unit product cost at $149, which they've derived here, direct materials of $84, labor $45, and overhead of $20. And then we're told the members of a wedding party have approached the jeweler to buy 20 of those at a discounted price of $169.95. They'd like some customization though. That would require buying a special tool at $250 and would increase the materials cost per bracelet by $2 as well. And there'd be no other use for that tool once this particular special order was completed. So to analyze that opportunity, it said Imperial has determined most of its overheads fixed and unaffected by variations in volume, essentially, but $4 of that overhead is variable with respect to the number of bracelets produced. And the company also believes accepting that order would have no effect on its ability to produce and sell jewelry to other customers. So in other words, we're not poaching our own customer base or our own demand by filling this particular special order. And then it said, finally, the company could fulfill the wedding party's order using existing capacity. So there's no expansion required to fill this relatively small order. So the first requirement is to determine the financial advantage or disadvantage of accepting that special order. And then second, to make the determination should the company accept it. So in this scenario, in all of our special order decisions, really we're just trying to decide, is it financially beneficial to accept the order? And that determination is made by, is the incremental revenue from the special order greater than the incremental cost of filling the order? So let's think about those components for this particular special order. So the incremental revenue that would be earned would be the discounted price that we'd be selling them for of $169.95 times the 20 bracelets that the wedding party wants to buy. So that's the additional revenue, that would be earned by this special order. Let's think then about incremental costs. So we would have direct materials costs, right? That varies with volume. We'd have direct labor cost. We would have some variable overhead cost. And then we also would have this special equipment or tool that we'd have to purchase to do the customization that the wedding party wanted. So let's think about some numbers for that. Direct materials right now is $84 per unit. We also know that for this order, direct materials would increase by $2 per unit. So what we're saying there is the $84 for the normal unit plus the $2 in extra materials per unit for this order times the 20 orders would mean incremental materials cost of $1,720. Labor doesn't change on a per unit basis, so it's the $45 per unit times the 20 bracelets, or $900. And then over here, overhead, they did say was $4 per unit in variable overhead cost. So we can just take the $4 times the 20 units. And then again, that special tool, we'd have to buy that thing for $250, and we get no other use out of it. So we'd essentially just be throwing it away after this order was filled. So then our bottom line potential incremental profitability is the increase in revenue, the $33.99, minus all the incremental costs. So the materials, the labor, the overhead, and then that special equipment in its own category. So we can see though that that's $449 on the positive side. So we'd say that the financial advantage of accepting the special order is the $449. So part two, should we accept the special order? Yes, they should, because that's greater than zero. There is potential incremental profitability to be made from that special order. And that's essentially what all of our special order decisions boil down to. Next on our list of practice is exercise 12-5, a volume trade-off decision. We're going to look at how to potentially make the best use of limited resources, some things you're reading about in chapter 12. So 12.5 said outdoor luggage makes high-end hard-sided luggage. Here's data concerning 3 of their most popular models, the Ski Guard, Golf Guard, and Fishing Guard. So we know the selling price per unit, the variable cost per unit, and then how much injection molding machine processing time 1 unit of each product takes, as well as how many pounds of plastic pellets each unit of this particular product takes. So the first requirement said if we assume the total time available on the injection molding machine is the constraint in the process, how much contribution margin per minute of the constrained resource is earned by each product. So let's look at the ski, golf, and fishing guards on a per unit basis first. So this is CM per unit of product. As we know from our study early in the semester, contribution margin is always selling price minus variable cost. So for the ski guard, $200 price minus $60 in variable cost means it has a CM per unit of $140. The golf guard has a price of $300, cost of $140, so a CM of $160. And then the fishing guard, $255 and variable cost of $55, so CM per unit of $200. So before we look at the use of limited resources, let's just think about the potential profitability of our product so far. All things equal, if we were just looking at this from an analytical standpoint, we'd say, well, the fishing guard is the most profitable product. Every unit we sell generates the most contribution margin, so we should focus sales there. But in this case, we have some limited resources to consider, so let's do that here. Part 1 said assume that the time on the plastic injection molding machine is the constraint. So we're going to be first looking for CM per minute in terms of its use of that resource. So the ski guard has CM of $140 per unit, so per suitcase, but it takes 2 minutes of processing time on that machine. So we're just saying the $140 per unit divided by 2 minutes means contribution margin of $70 per minute for every minute we spend processing that particular product. The golf guard had a CM per unit of 160, so we'll divide that by the 5 minutes that each unit takes to process on the injection molding machine, and that generates CM of $32 per minute. And then the fishing guard, CM of $200 per guard divided by 4 minutes, and that's CM of $50 per minute. So part 2 said which product offers the most profitable use of that machine. Well, then it's the ski guard. If our bottleneck, if our constraint, if our limited resource is this injection molding machine, we can only pass so many things through it a certain amount of time, we should focus on passing through the ski guard because it generates $70 per minute of that constrained resource use. Part 3 said, let's assume then that there's a shortage of plastic pellets, so we've had to cut back on production, and our new constraint becomes this amount of plastic pellets. So now we want to determine the CM per pound of that limited resource. And the calculation's similar. We want the CM per unit of product, so $140 here for the ski guard, divided by the 7 pounds of pellets it uses, $20 per pound. The golf guard had the CM of 160 per unit, divided by 4 pounds, or $40 per pound. And then the fishing guard, $200 per unit, divided by the 8 pounds it takes, or $25 per pound. So to answer part 4 here, well, now the golf guard makes the best use of that limited resource. Every pound of pellets we use, if we have to kind of pick and choose, we should be dumping all of it first into the golf guard and filling that demand, and then with what's left going to the fishing guard and then to the ski guard, because the golf guard generates $40 in contribution margin for every pound of pellets we use to make that particular product. And then number 5 said which product has the largest CM per unit. Why wouldn't that be the most profitable use of the constrained resource in either case? And we started to hint at that earlier. The fishing guard on a per unit basis had the greatest CM. So if we looked at that level, we'd think that we should devote our resources to selling as many of those as we can. But if we have a limited resource, we have a constraint, that's not necessarily the case, right? If it was the processing time on the molding machine, the ski guard was most profitable. If it was the pounds of plastic pellets, that raw material, then the golf guard was most profitable. Okay, the last problem to look at for now is exercise 12-7, sell or process further decisions. So here Dorsey Company makes 3 products from a common input in a joint processing operation. Joint processing costs up to the split off, total $350,000 per quarter. Stop there for a second. You recall from your reading in chapter 12 and from our discussion of the notes that costs incurred up to the split off point become sunk costs and are always irrelevant for this decision of whether to sell or process further. Right? They're already been incurred up to that split off point, so nothing that's happening after that should affect anything as far as that goes. For financial reporting purposes, the company allocates those costs to the joint products on the basis of sales value. Fine. Unit selling prices and total output at split off are shown in this first box. Each product can be processed further after split off. Additional processing takes no special facilities, and then we know the additional processing cost per quarter and the unit selling prices after further processing in this second box. So the first requirement is to determine the financial advantage or disadvantage of further processing each of the three products beyond the split off point. So as you know from our discussion of Chapter 12 notes and from your reading, these types of decisions boil down to, does the incremental revenue earned or potential revenue earned from that processing exceed the additional costs of that extra processing? If it does, we want to do that extra processing. If it doesn't, we'll say no, we'll just sell it at split off at the lower price. So let's look at all three products separately here. I'm going to just lay out A, B, and C top to bottom. For product A, we can sell it at split off at $16 per pound, and our quarterly output's 15,000 pounds. Or we can process it further at a cost of $63,000 and sell it for $20 a pound. So let's think about, we're going to lay these out separately, the incremental revenue and incremental cost, just to kind of be extra clear on the decision point. The incremental revenue for product A is the $20 per pound we can sell it at after further processing, minus the $16 we'd sell it at split off, so the 20 minus the 16, times the 15,000 pounds in output that we can produce each quarter. $60,000. The additional processing costs to do that processing, though, were $63,000. So the difference, 60 minus 63, says, well, we have a potential disadvantage financially of $3,000 to do that additional processing. So all things equal, we won't do that. Product B sells for $8 per pound at split off, or $13 per pound after additional processing. So the incremental revenue there is the $13 per pound minus the $8 per pound times the 20,000 pounds that we can produce, for a total of $100,000. That only required additional processing costs to get it there of $80,000. So the difference, or $20,000, is our potential financial advantage of doing the additional processing on product B. And then product C, we've got incremental revenue of the $32 per gallon if we sell it after split off in additional processing, minus the $25 per gallon selling price at split off, times the 4,000 gallons we produce each quarter, or a total of 28,000. And additional processing costs to consider are 36,000. So on a net basis, 28,000 minus 36,000 would be a financial disadvantage of $8,000 to do that additional processing. So based on our sort of rudimentary analysis here, we'd say don't process product A further, do process product B further, and don't process product C further. One other thing we kind of assume away in these problems, we talked about this a tiny bit in the notes, is demand. So this all assumes that we have sort of unlimited demand for our product B, that we could do all this additional processing and still sell everything. A similar thing with A and C, that there's nothing else economically that factors into this, and it just is a matter of, does the incremental revenue exceed the incremental cost of doing whatever processing we're considering. So that's it for exercise 12-7. As always, let me know if you have any questions.